We're live. Sorry, guys. We're just having a little bit of fun back here, but we are live. Thanks for joining us for another edition of our Wednesday workshops. This is NuView Trust Company. My name is Nate Hare. I'm the Director of Retail Sales, and we bring these programs to you guys as investors, whether you're a NuView client or not, to really just understand areas of opportunity, how investments work in the alternative space, and specifically how alternative investments can look inside of a retirement account, the tax advantages you get from retirement accounts, the investment opportunities that you have with retirement accounts that go far beyond just investments in the stock market. So today's program, we're going to kind of go back and talk a little bit about the basics, but talk about some areas of opportunity when it comes to real estate investments and real estate investment properties in 2022. And we have an expert on the subject because our expert today runs and operates a turnkey real estate operation that really operates on a national level. He has decades of experience in the space. He also has a lot of familiarity with using self-directed IRAs, not just his own, but self-directed IRAs, old retirement accounts of clients that are looking to invest passively into some of their investment opportunities. We're not selling anything to you guys today. This is just for education purposes only. So let's just jump into it and talk a little bit about NuView before we bring him on and tie it all together. Our program is intended to really engage people about what this self-directed IRA is. That's really the product that we have at NuView Trust Company. If you're new to the program, I have to let you guys know that a self-directed IRA is not some magical type of IRA that gives you different investment options that you wouldn't have at your IRA at Fidelity or Charles Schwab. Self-directed is just a marketing term. When you have an individual retirement account or an old 401k, an old 403b, an old 457 plan, you've got some sort of tax advantage plan sitting out there somewhere in limbo or otherwise. It's important to know that those the investments that can be placed in those plans is almost limitless. There's no rules or regulations. There's very little rules or regulations as to what you're allowed to hold in your individual retirement plans. The only time that you really face a brick wall or some restrictions is when you have a custodian that manages that retirement account that sells you things and says, we'll only allow you to hold these types of investments in your IRA. When you talk about self-directed IRAs, that's an IRA with a company like us, but self-directed is just a marketing term. The reason why we call our IRAs self-directed is because our clients have to choose their own investments. So that comes with a greater sense of responsibility, but it also broadens your spectrum of available investments that you can go out and invest in. So what do our clients like to invest in? I'll share that with you in a brief moment. But when you talk about self-direction, let's talk about the benefits first. Why would someone want a self-directed IRA that they have more investment options, but they have to do a little bit more work to find the investments? Well, the first benefit is if you really want true diversification with your retirement assets, is you want to look to all investment classes. I'm not talking just stock market assets and mutual funds. I'm talking about private assets, rental property, land. You can even throw cryptocurrency in there, promissory notes, secured by property, notes payable, investments in the syndications or apartment buildings. The list goes on and on. The IRS doesn't tell us what we're allowed to invest in with our individual retirement accounts. They only tell us what we're not allowed to invest in, and the list is really short. Life insurance contracts and collectibles are the only two investments that are not allowed in an IRA or even a self-directed IRA. So if you want true diversification, do what most of our clients do. They have a NuView IRA that holds their alternative assets. They have a Fidelity IRA that holds their traditional assets. You're not limited as to how many IRAs you can have. You can have as many IRAs as you want, and you can move money back and forth between those IRAs at different custodians to invest in what you feel best investing in. And why do people like to use the IRA instead of their own money? The tax savings you get. IRAs by definition and 401ks and 403bs, they're by definition tax exempt, right? They're tax exempt trusts. You as the IRA's owner or the retirement account's owner, you're just the fiduciary of that trust. But you get tremendous tax savings by putting money in these accounts, investing within these accounts, And therefore you bypass any taxation on capital gains. You can grow your bucket of money in a retirement account much faster than you can your own bucket of money because you pay taxes annually on the money you earn. IRAs don't pay taxes annually on the money they earn. So we'll talk about the different types of IRAs you can use as a tax shelter, but the self-directed IRA allows you to take those tax savings or take those tax benefits and invest in things outside of the market or invest in things that you're knowledgeable about. I'll give you a little background about our speaker. He's very knowledgeable about real estate. So where do you think he will make the best decisions for his retirement assets? By having an IRA that allows him to invest it into real estate, okay? Not the stock market. So he's investing in what he knows best. So we're taking the words straight from the horse's mouth. He's gonna talk about what he does with his own IRA, but talk about what he sees as far as market opportunities in real estate going forward into this year. What types of plans can be used at NuView to self-direct? Okay, we have 7 types of plans that our investors can choose from. You're not limited to having just one. I always encourage people to look back at these plans on a periodic basis and say, do I have every plan that I can set up for myself or my spouse or my kids or just my family? Do I have enough accounts set up so that I'm sheltering my assets away from as much taxation as possible? We have personal plans, which would consist of your traditional IRA and your Roth IRA. We have employer plans. If you're self-employed, you can also have an employer plan that can be self-directed. And that can be either a SEP IRA, a simple IRA, or even your own individual 401k. What a great tool, especially for the audience members on this show. If you are self-employed and you invest in real estate, there's a lot of great advantages to having those investments held in the name of your solo 401k. And then we also have non-IRAs that can also be self-directed and invested into real estate or other alternative investments. And that would be your health savings accounts and education savings accounts. If you're looking for a deeper dive into these types of accounts and how they work, just go to our YouTube channel or go to our website. That'll direct you directly to some of the videos that we've already filmed that kind of dive into the nuts and bolts of each of these plans. But if I oversimplify, what you want to do as an investor, as someone looking to escape taxation, is you want to set up as many of these plans as possible. If you're a husband and wife and you got a couple kids, you should have Roth IRAs set up for both of you, both spouses. If you're self-employed, you should also look to have an employer plan. If you have the right type of health insurance, you should have a health savings plan. And if you've got kids under the age of 18, you should be setting up Coverdell education savings accounts for them. All of those accounts grow either tax deferred or tax free if you use it right. So if you're not utilizing these plans and you're trying to save for retirement or pay for health expenses or put your kids through school, and you're trying to do that on the money that you earn as a tax-paying individual, that's the wrong way to think about it. You are going to have to make so much more money to consume the expenses you need to make, because you got to factor in taxes every single year, especially if you're an investor. So these are the types of plans that will allow you to escape taxation. Now, does that mean you should put all of your real estate investments into tax deferred plans like this? No, there's benefits to having real estate investments outside of an IRA where you get depreciation if you're trying to reduce your taxation. But depreciation is a moot point in an IRA or an HSA or a Coverdell because there's no taxes to depreciate against. So it's an easier way to grow a bucket of money, but you should really be doing both. So what do people invest these accounts in at NuView? Well, anything that's considered an alternative investment and anything, including the things on this list, which are some of the most common investments we see. We see investors take their IRAs, 401ks, or HSAs and invest those directly into real estate. How does the process work? I'll talk a little about that at the end, but we're not handing you the money to go buy real estate. That would be a distribution to you. When you have an account set up at NuView and you're instructing us to buy and sell real estate, what we're really doing is we're exchanging your assets of cash for an asset of a deed, or exchanging your assets of cash for an asset of a note. Whatever the investment is, it's being owned by the IRA and being administrated by NuView. Okay? What do people like to invest in? If it's real estate, they buy foreclosures, tax liens, apartments, real estate options, condominiums, land, commercial property. General rule of thumb, any investment strategy that works outside of an IRA works inside of an IRA. You just have to remember your IRA is a separate legal entity, and you have to work through a custodian like NuView to make sure it's done right. Some clients like to be more passive with their IRA investments. Right? They like to invest in promissory notes, where you have a lender which is the IRA, and a borrower, which could be a real estate investor. And those notes can be secured by real estate. What a great way to get a little bit of mailbox money without dealing with toilets or tenants. Other clients like to invest passively through private entities. That would be the private entities ran and operated by other investment sponsors or other investment gurus, people who are actually out there finding investments, and you just want a piece of equity or a piece of interest on those investments by investing into their LLC or into their joint ventures, or into their partnerships or their trusts, that the underlying investments in those entities is real estate or something else. And then we have a lot of clients that invest in cryptocurrency. That's not something that you can invest directly in, Fidelity or Charles Schwab. You've got to go and invest into a cryptocurrency ETF. But if you want to own direct ownership of Bitcoin or direct ownership of Ether, well, you've got to go through an IRA company that's willing to administrate those assets. And hello, that company's name is NuView Trust Company. We actually have several companies that we use that will hold the Bitcoin, and we just make sure that your IRA is vested correctly on the accounts that those platforms operate and manage. So all of these are available investment options, but really when it comes down to it, you tell us what you want to invest in. We show you how the paperwork works, and ultimately we hold and administrate the assets on your behalf or on the behalf of your IRA. So we're going to talk a lot about real estate today, and I don't want to spend too much time going over. I'd like Matt Bowles to jump in here. Matt, are you with me?
All right. How are you, Nate? Good to see you.
I'm doing good, my friend. I will say Matt is a client of ours. Matt, you still there?
Yep, I'm here.
Okay, sorry. Matt is a client of ours. He actually is in the process of setting up his accounts, and he's doing some great things. He's going to be rocking and rolling here and moving his stuff over. And, I don't want you to talk so much about that because I know you got a presentation, but I do like to just mention that because when people are watching this program, it's great to hear it from somebody who is both on the active side of real estate investing by out there finding real estate investments for himself, but he's also out there looking for opportunities to invest his retirement accounts, because you understand the tax benefits you get through the retirement accounts you have set up with us.
Yeah, and I'm happy also to share exactly what I'm doing with you guys, because you guys and your team, Nate, has been super helpful in helping me structure the right thing for me. And I'll share with people exactly what I'm doing. So I have my Roth IRA with NuView, and then I also have my solo 401k with NuView. And all the money in my solo 401k is in the Roth side of my solo 401k. So I have two fully Roth self-directed retirement accounts. And so what I've done is I've set up an LLC, which you guys referred me to a company that helped me to do that. So I have an LLC set up, and the two owners of the LLC in 50% shares are my Roth IRA and my solo 401k. Okay. So it's a 50-50 ownership by my two retirement plans, both of which are with NuView. And then I personally am the manager of the LLC. So I'm not an owner. My retirement plans are the owner, but I am the manager, which means that I have checkbook control of the funds that are in that LLC, and I can put them into anything that I want. I can sign a contract for a rental property. I can invest them into cryptocurrency. I can do any of those things that I want. And so that's the structure that I have set up for myself that works for me, for my needs with NuView. Your team has been amazing in helping me to navigate that and to do that properly. And I am in the process now of buying a rental property in that, which I will talk about during the presentation. So let me know when you're ready to kick it off, Nate.
Awesome. Yeah, no, I want you to kick it off. Just before you do that, I want to remind everybody, we're going to take some live Q&A throughout the program and after the program. So go ahead and type any questions that you have for myself or Matt, type them into the chat box. We'll get to those at the end. And if we don't get to quite all of them, if we run short of time, Matt's going to give his direct point of contact, so you can reach out to him if it's for something for him. And obviously you'll have my point of contact if you have some IRA questions. So Matt, take it away. Tell people what they need to know about Matt Bowles. I know a lot about you, but tell them what we're looking at for 2022.
Absolutely. Let's get into this. All right. So I am going to share my screen. And then we're just going to rock through this presentation here. So what I wanted to do here is go through a bit of an update on the 2022 real estate market situation. But first, let me just introduce myself. So my name is Matt Bowles, and I am one of the co-founders of Maverick Investor Group. We have been featured in a lot of the different real estate press over the years. You may have heard of us. And basically, we are a licensed real estate brokerage in the United States, but we do not do traditional real estate brokerage stuff, right? We don't help people buy houses to live in or list properties on the MLS or things like that. We do one thing and one thing only since we founded the company in 2007. And that is to help individual real estate investors like you buy turnkey rental properties in the most investor advantaged US real estate markets, regardless of where you live. And those markets, of course, change over time, right? With different property cycles and so forth. And we've helped people buy rental properties in over a dozen US states in the last 15 years, right? So we call this the Maverick approach. We help you to use rental properties to accelerate your wealth building velocity and design your dream lifestyle through real estate. Okay. So specifically in terms of how does Maverick Investor Group work? And this is important context for all the stuff I'm going to be sharing with you today, right? Number one is that we help you to buy rental properties in the most investor advantaged markets where no matter where you live, right? So there's no geographical restriction. You can live wherever you want to live or wherever you need to live, but don't be restricted on buying properties in your local market. We think you should be able to buy in the best markets no matter where you live. Number two, we help you to buy turnkey rental properties, which means they're either new or fully renovated. They have tenants and local property management already in place so that you don't have to be the rehabber or the landlord. Number three, we help you to access off-market properties that are not available to the general public. And number four, we have the deals come to you so that you don't have to spend your time going out there and looking for them. You can just evaluate the deals, see if they're a good fit for your buying criteria, and then, of course, do your due diligence on the deals, have your home inspection, your appraisal, all that kind of stuff. But you don't have to spend your time finding them in the first place. We will present these deals to you, okay? So let's talk about what you're gonna learn today on this webinar. Number one, why the advantages of buying rental properties are turbocharged in 2022. What is going on in the market right now that makes this year possibly the best year to buy rental properties of the last decade? I'm going to show you that. Number two, how to identify investor advantaged real estate markets. Number three, 4 reasons to buy turnkey rental properties. We're also going to talk about how to conduct your due diligence if it's an out-of-state rental property. And then I'm going to share the market where I am currently buying my rental property with my NuView self-directed retirement plan. I'm going to show you the property and what the numbers look like. And then finally, I'll share the number one mistake that real estate investors are making right now and how to avoid that. Then we're going to take your live Q&A at the end, and that'll be a wrap, okay? So before we talk about how the advantages of rental properties are being turbocharged in 2022, we first need to talk about what are the advantages of single-family rental properties as an asset class, okay? So we have this as a premise, all right? Most investments that you make will typically have one profit center, right? If you buy a stock, you hope and pray it goes up in value. If it does, great, but then you got to sell it and pay tax on your capital gain and hope that whatever's left over beat the rate of inflation. And that's your best case scenario. Sometimes if you get a dividend paying stock, there'll be 2 profit centers, right? But that's usually about it. When you buy and hold a rental property, not flip, hold a rental property, then you actually open up 5 potential simultaneous profit centers that are all working for you at the same time, okay? Number one, you got your positive cash flow. So your tenant pays the rent every month. That covers all of your expenses if you buy right. And then whatever is left over on top goes into your bank account, and that is your net positive cash flow. Number two, you've then got your market appreciation potential, right? If home prices go up in value, you build equity through home prices going up in value. Also, though, you build equity by your tenant paying down your mortgage principal. Okay, you get a mortgage on a property, becomes an expense that's also covered by your tenant's rent. So basically your tenant is paying down your mortgage principal every single month. So even if you bought a property and the market did not appreciate a single dollar in value over 30 years, it's never happened in the history of real estate, but let's say that happened, you would still own the property free and clear at the end of 30 years because your tenant would have paid off your entire mortgage and you would have built all of that equity anyways, even without the market appreciation. That's why it's a separate profit center, right? Real estate is the most tax advantaged asset class in the United States, bar none. And number 5, really importantly, right now at this historical moment, it is a hedge against inflation. And not just a hedge, it actually allows you to profit from inflation. Okay, this is really significant. Okay, first of all, home prices rise with inflation. Second of all, rents rise with inflation, and you renew your lease every year and you can raise those rents to keep pace with inflation. But also, when you borrow money with a mortgage, you are borrowing those dollars in today's real dollars, and you are paying the bank back in future diminished nominal dollars that are worth less than the ones that you borrowed. Okay, so that's called inflation-induced debt debasement. Okay, the debt is being debased by inflation, so you are actually profiting. The more inflation goes up, the more it debases your debt, the lower the dollars are worth that you're paying the bank back in the future, right? So you're actually able to profit from inflation when you own long-term rental properties. Okay, real estate is also the most debt-favored asset class. You can get a mortgage and use the bank's money to acquire your asset, right? And here's the cool part. Let's say you only put down a fraction of the price, right? If you're using a traditional mortgage outside of a self-directed retirement plan, our clients are getting 80% mortgages, putting 20% down. If you're buying it inside your self-directed retirement plan, it is going to be a higher down payment and a higher interest rate, but still you can leverage, right? So let's just say though that you bought it inside your self-directed retirement plan, you put 35% down, and the bank puts down the rest. Okay. Well, if that property goes up 10% in 1 year, let's say, well, that's 10%, not on of your 35%, that's 10% of the whole property, right? So if you bought a $100,000 property and put down 35 grand and the property went up 10% a year, but you only put down $35,000. So if you made a $10,000 gain on $35,000, all of a sudden now, right, your gain is way up into almost 30%, right? Just on a 10% rental property increase. So, and then of course you're borrowing those in today's dollars and you're paying the bank back in future dollars that are worth less than what you borrowed. All right. So that's in general how it works. So let's now talk about the trends that are turbocharging these advantages that I just talked about in 2022. Okay. So first of all, we have inflation, which is skyrocketing. All right. The official rate of inflation. Now, a lot of people think that inflation is actually higher than the official rate of inflation. I'm not going to get into that. We're just going to be as conservative as possible here and use the official rate of inflation. The official rate of inflation at the end of 2021 was 6.8% annually. Okay. Now, compare that to the decade prior. The decade prior, the annual rate of inflation averaged 2% a year. Okay. So you are talking about more than 3 times increase in inflation. All right. And the higher the inflation, the higher the profit for the owners of rental property. Okay. The more home prices are pushed up, the more rents are pushed up, and the more your debt on your mortgage is debased. Okay. So with increased inflation, that's increased profit if you're buying and holding a rental property. Now, mortgage rates are still at historic lows, but they are starting to rise, and they are likely to rise over the course of this year. Okay. So the sooner you lock in a historically low mortgage rate, the lower your expenses will be, because that is going to be a fixed rate mortgage that you're going to lock in, right? So the sooner you lock it in, the lower it will be as an expense, the higher your cash flow will be. And then your cash flow would just keep going up as you continue to raise your rents year over year, right? mortgage rates are well below the rate of inflation right now. Okay. Even as mortgage rates have gone up, they are still well below the official rate of inflation, which is incredible. And here's a kicker that a lot of people don't realize. Rising mortgage rates, okay, the reason they're doing that is because they're going to try to ease inflation. All right. So if you look back historically, since 1994, all 6 times that they have raised interest rates since 1994, what has happened, which has correlated with the rise in interest rates, is that home prices have gone up. Okay, now that's counterintuitive to some people. They're like, oh, maybe if they raise interest rates, wouldn't home prices go down? But no, in fact, if you look historically, all 6 times, it's not guaranteed, right? It's not causality, but there is a correlation where all 6 times they raised interest rates, that has correlated with a rise in home prices. And one of the reasons for that is because if you're a primary homeowner, you own your house and you've got a low mortgage rate locked in and the mortgage rates go up, okay, you know that if you were to sell the house you live in and buy a new house, you'd have to get a new mortgage at a higher interest rate. So even if your new house costs the same amount, the mortgage on that new house would be at a higher interest rate, which would raise your monthly payment, right? And that actually disincentivizes people to sell. It incentivizes them to stay in the house that they have. It reduces the supply of available rental properties, and the reduction in supply relates to an increase in price. Okay, so that's one of the reasons why that correlation has happened every single time that they've done that. Let's talk more about supply. These are the active listings in the United States right now in the real estate market. Look at that trend line over the last 2 years. Supply is extremely low. There are supply chain backups with materials, there's labor shortages and everything else. And right now, housing supply is very, very low. And that relates to massive upward pressure on home prices. Okay, there's increasing demand for new household formation, right? During the COVID-19 quarantine, right? A couple things happened, right? In some cases, couples that were quarantined together had babies and they now need bigger houses. And in some cases, they spent a lot of time together and realized that maybe they shouldn't be together and they broke up. And now there's need for additional household formation, right? And then also, housemates that were living together, everybody working at home. Now they're realizing, well, maybe we actually need our own place, more demand for household formation. But there's a major supply constraint on available homes. As I mentioned, labor shortages, construction material shortages and all that. And plus you've got the rising mortgage rates, as I mentioned, which further constrain the supply of houses. All of this puts upward pressure on home prices. And it's all happening at the same time. Guess what? What's going on with rents? Rents are increasing at historic rates and vacancy is at a historic low. Rents have increased nationally at over 10% just in the last year. And the housing shortage is driving people to rent, right? If they can't find housing, there's not enough housing, then more people will rent. And vacancy rates are at the lowest rate that they've been since 1994, which obviously is extremely beneficial to rental property owners, right? To keep vacancy as low as possible, keep your cash flow as high as possible. So what's been one of the main impacts of COVID-19 on the real estate market? We get this question a lot. And I would say that one of the main trends that's likely to come out of this COVID-19 era is the de-densification trend that is increasing demand for single family rental properties in the suburbs, right? What's happening and has been happening over the last couple of years is people are moving out of crowded apartment buildings with shared common area spaces and all that kind of stuff into the more sparsely populated suburbs, right? Moving out from the city centers into the suburbs, getting those detached single family homes that don't have shared laundry rooms and all that kind of stuff. And so there is an increased demand for that segment of the asset class in particular. All right, so let's talk about now identifying investor advantage real estate markets. How do we do that? First thing is take a look at the demand drivers, okay? Look at things like job growth, population influx, low unemployment, a diversified economy, increasing per capita personal income, low cost of living, revitalization projects, right? Things that help the real estate market to do well and to attract quality tenants, right? Now, not every market is going to have every single one of these, But these are the types of things that you want to look at in terms of demand drivers and economic indicators when looking at rental property markets. Okay. You also want to look at price to rent ratios. Okay. So as a real simple example, a gross rent multiplier is just the purchase price divided by the annual gross scheduled rent. Okay. So if you have a $500,000 property and it rents for $2,500, you divide the $500,000 purchase price by the annual rent, right? So $30,000 a year, and your gross rent multiplier is 16.6. You can also express that as a rent to value ratio as 0.5%, right? The monthly rent of $2,500 is 0.5% of the purchase price. Okay, so those are two expressions of price to rent ratios. Another example, let's say you have a $100,000 property and it rents for $1,000 a month, right? Well, now you divide 100,000 by 12,000, your annual rent, and the gross rent multiplier is 8.3. The lower the GRM, the better, by the way, and the higher the RV ratio, the better. So the gross rent multiplier is 18.3, and the RV ratio is 1%. Okay, so $1,000 a month is 1% of the purchase price. Okay, so that's the first very high level metric. Okay, and when you look at different real estate markets, you're going to see the price to rent ratios are going to vary quite dramatically from certain markets to other markets. Okay, so that's a high level indicator, but it's absolutely not sufficient for analyzing your property. You need to look at the expenses, and in order to do that, you need to look at the capitalization rate, which takes into account your taxes and insurance and property management fee and homeowner association fees and all of this kind of stuff, right? It also, a capitalization rate should include an estimate for vacancy and maintenance. Okay. Now, when you start adding in all of your expenses, you're going to also find that different markets have different expenses, right? Some markets have much higher property taxes, for example, than others do. And that is why this 1% rule, let's say, that your rent should be 1% of your purchase price can be very misleading, right? Or any other rule of that nature. And the reason is, let's just take this example, all right? Let's say we have two different markets and we have a $100,000 purchase price and property X has $1,000 a month rent and property Y has $900 a month rent. Which one would you rather have? Most people would say, oh, I want property X. But smart investors would say, let me see the expenses before I make my decision, okay? So if we look at the expenses, we realize property X is actually in the state of New Jersey, and therefore the property taxes on a $100,000 house are $2,490, right? And then let's say the insurance between the properties is the same and the property management, and we'll just put an estimate for maintenance and vacancy and all of that. Okay, so the cap rate is 6.2%. Now we got this other property. Okay, let's say this property is in the state of Alabama where the property taxes on $100,000 property are only $410 a year, right? And then you've got the insurance and the property management and everything else the same. Okay, so all you've done is you have changed states and you have changed property tax rates. And now the property that rented for only $900 a month is actually a cap rate, has a cap rate that is 7.3% instead of 6.2%. Okay, so significantly higher. So the net result is that, of course, property Y in this case is the better performing property with respect to cap rate analysis, which is why it's important to look at the expenses and not just the price to rent ratio. Now, the other thing you want to look at when evaluating markets is the property cycles and understanding that markets go in cycles, right? So a decade ago or so, back in 2011, Phoenix was one of the hottest markets in the country. We're helping our clients buy there. It had just come off the major real estate crash, and it was an amazing place to buy. What has happened since then is that home prices have skyrocketed and rents have not increased at the same pace as the home prices there. And so what's happened is a process of yield compression. Okay, so if you're buying for a lot more money, but you're not making a lot more rent, then of course your cap rate is going to get squeezed, right? And it's going to come down, it's going to become lower, and your cash flows and your yield is going to be much lower. And so after that, then we help people buy in the Atlanta market in 2012, amazing market to buy. Guess what? Same thing happened there, right? 2013, Houston was our most popular market. Guess what happened there? Same thing, right? And so one of the advantages that we offer to our clients is we help them to buy, to do these assessments in the different markets And at the time that they're ready to buy, help them to buy in the best market for them, okay? The other thing to look at here, for example, is markets that are more stable versus these kind of roller coaster markets. So the top graph is the graph for Phoenix, Arizona, and you can see how much of a roller coaster that was. The bottom graph is the graph for Indianapolis, Indiana, and you can see that some of these Midwestern markets were much more stable through the recession. They didn't decline as much, and so forth. So much more stable in terms of the cash flow market, although they are now also going up in value at quite an impressive rate. All right, let's talk about 4 reasons to buy turnkey rental properties in particular. And just to be clear, what we mean when we say that, we're talking about a property that's either brand new or fully renovated. It has a long-term tenant in place on a lease, so it is performing and cash flowing when you buy it. And it has a local property management solution that is in place at closing so that they are collecting the rent, handling the maintenance, dealing with the tenant, so that you are the investor and you are not the landlord. Okay, so that's what we mean by turnkey rental properties, and this is really, really important. The first reason to do it is because of the value of your own time, right? Landlords deal with tenants, toilets, and trash, whereas real estate investors make decisions and cash checks, right? That is a really, really important distinction. Some people like to buy distressed properties and they like to renovate them and they like to design them and they like to manage and be a landlord. And if that's your thing, great, no problem with that. But those are not our clients, right? Our clients are folks that want to buy in the best markets, regardless of where they live, to cash flow on the day that they close and not to be the landlord or dealing with the tenant, right? So that's the specific niche that we work in. The other reason to buy turnkey is dramatic risk mitigation. Okay, there's a huge amount of risk in the upfront process, and you are letting someone else absorb the risk of acquiring the distressed asset, pricing the rehab, managing the renovation, borrowing the hard money, absorbing the holding costs when the renovation goes over time or it comes in higher than the original estimate, right? And then absorb the upfront vacancy loss when the renovation is finished and you're trying to get a tenant in there and marketing and showing the property and leasing it out all before there's any cash flow at all. Somebody else has already absorbed all of that. You leapfrog over the entire thing and you close on a performing cash flowing property. You just evaluate the deal, conduct your due diligence, and then you close on a cash flowing asset, right? That's what our turnkey properties allow you to do. And then you also get to leverage the economies of scale of professional turnkey companies. So all of these properties that we work with are coming from professional companies that do this at scale. So they buy a number of distressed properties at the same time. They buy their renovation materials in bulk. They run their own construction crews, right? So they're able to get these done at a level of efficiency that far surpasses what an individual person could get it done for. And you get to leverage that by buying that. And then finally, it removes geographic restrictions, right? So you can buy in the best markets regardless of where you live. You're not constrained to your local area, and you can actually own in the best markets, right? All right, so if you do buy out of state and you do decide that there's some out of state markets that are in fact better than yours and you're interested in the turnkey stuff, how do you conduct your due diligence if you're buying a property out of state? Well, I would suggest that you conduct it exactly the same way you would on a rental property that's right down the street from where you live. Because unless you are a professional home inspector, then you actually personally walking into the property is not going to add that much value to the due diligence process, right? You are going to hire a professional home inspector to go and professionally inspect the property, whether it's down the street or whether it's in a different state. That person works for you, not for Maverick, not for the seller, not for anybody else but you. They're going to give you the honest assessment of that. You're going to have any remaining items punched out by the seller before closing. You're going to get pictures, you're going to get video, you're going to get all of that, right? So let's talk about some other things that you're going to do. And again, whether it's out of state or not, you should definitely do these things anyways, right? Number one, verify your operating expenses. So, verify, there's a public website you can go to verify what the property taxes actually are, right? Get a quote from the insurance company about exactly what your insurance payment will be. All these things, you're going to verify them. Then you're going to verify your rent, right? You're going to verify that there is a signed lease. This is how much it's for. You're going to verify that with the property management company. Okay. And you're going to verify the market rent. Okay. Because if your tenant moves out, you are going to want to make sure that you can reliably release that property in 30 days for approximately the same amount or more. So you're going to want to verify that what the tenant is paying is in fact the market rent. And you can do all of this stuff, by the way. There are third-party services. I'm going to share one with you right here, right now, if you want to get a free report, because the other piece of this is to evaluate the risk of the micro market. So understanding, the school districts and the crime rates and the, all that kind of stuff. There is a service called Rent Facts, and you can actually pull, if you use, this is our affiliate link here. If you go to this website, you can actually pull a free Rent Facts report. Like your first one will be free if you use this link. So if you want to just grab a free one just to see what it's like, and you can type in a property address that maybe you're familiar with, or maybe you own a rental property, or maybe you're looking at evaluating a rental property, and you can just pull a report and just see what it will show you in terms of the market rent and in terms of other risk factors for the micro market. And then one technique that I recommend to people is to interview multiple property management companies. Property management company is third party. They don't, have an interest in whether you buy this particular property or not, right? You could just call them up on the phone and say, hey, I'm planning to buy this property, and I want to just ask you a few questions about it, right? And you could ask them about rental demand. How much could they rent it for? If it went vacant, how long would it take them to get a new tenant in there? How high demand is this particular neighborhood or this micro market, compared to other places in the city? Those kind of questions, and ask 3 different management companies the same question and get 3 totally separate third-party opinions on it is a really good way to do that. And again, I would recommend all these things, whether you're buying out of state or you're buying down the street from your property, right? Same process. All right, so let's get into where did I buy my property in 2022, and with my NuView retirement plan, LLC. I bought in what is the most popular market for our clients over the past year, and I bought in this market as well, which is St. Louis, Missouri. Okay, this is our most popular real estate market in the country right now. It is uniquely advantageous to real estate investors. And let me go through and show you why. I'm going to give you a little market overview and use some of these techniques that we learned just now about evaluating a market and all these different things. Let me apply it to how I chose to buy a property here, and I'm going to show you the property that I'm buying. Okay, so St. Louis fundamentals. It's home to 8 Fortune 500 companies. Their gross domestic product has increased 29% in the last decade. It's over $170 billion now. Cost of living, though, is 12% below the national average, which makes it desirable for people to live there. It was ranked the top 10 most competitive large MSAs to do business, top 10 large American cities of the future. Unemployment rate is consistently well below the national average. This month, Bureau of Labor Statistics says the national U.S. unemployment rate is 3.7. St. Louis is 3% even, okay? And that's been consistently below the national average since we've been involved with that market. The rising per capita income in St. Louis, also significant, right? Because each year when you renew your lease, you're going to want to be able to raise the rent, and you want to make sure that your tenants can continue to afford to pay higher and higher rents every year. So if there's increasing per capita income, that's a very good sign. Also, when you go to sell your house down the road, you want to be able to sell it for more than you paid for it, and you want to make sure people can buy it for more money down the road. And so increasing income is a really, really good thing. Home price appreciation over the last year was 13% in St. Louis. And this is the property that I personally purchased. I'm going to show you guys the house, and I'm going to show you the numbers. Okay. So this property, and I'm buying this. I have this property under contract. Okay. And I'm buying this at $102,000 is the purchase price. And the rent is $1,000 a month for this. It's a single family home, detached. So my closing costs are probably going to be around $3,000, let's just say. And then my gross monthly rental income is going to be $1,000 a month. And here's the expenses it's going to cover. My property taxes are $108 a month. My insurance is going to be about $54 a month. My property management fee will be 10% of the gross rent. And then I'm just going to assume a vacancy and a maintenance estimate here, about 7% and 5%. Those, of course, are not fixed. But I'm just going to put those in there. It's a fully renovated house with a brand new tenant in there. So I'm just going to assume over time, these numbers, you can make those numbers higher or lower on yours. however you like. And then that means my total monthly expenses are going to be under $400 a month. And my net monthly cash flow is going to be over $600 a month flowing into my my retirement plan, right? $600 a month every month just coming into the retirement plan, which is a cap rate of 7.2% on this property. Now, if you are interested in checking out inventory, we have a number of properties, very similar numbers to this. Okay, if this is the type of thing that you're interested in, and you want to take a look at other properties that are available like that, those are available to view at maverickinvestorgroup.com/STL. I will tell you that most of the properties that you're going to see, the pictures are pre-renovated pictures because you put it under contract before the renovation is complete. Okay, so I reserved my property. The renovation is still going on right now. Okay, and then I'm going to close on the property when the renovations are done next month. Okay, so the pictures you're going to see are pre-renovated pictures, so just keep that in mind. But we have a webinar and stuff on our site that shows what the renovation standards look like and all that kind of stuff. If you are interested in learning more about that, that's the website to go and learn more about that. And now let me share with you the number one mistake that real estate investors are making right now, which is they're losing money by not buying because they are sitting on the sidelines. They have analysis paralysis, which is incredibly expensive. Like I cannot tell you how many clients a year ago had conversations like, oh, I don't know if I should buy or not. Is the real estate market in a bubble? Is this happening? Is that happening? Maybe I'll just sit it out and wait. And then they waited, and then everybody saw what happened last year, right? This year, 2022, the real estate investing advantages, as you just saw, are turbocharged. I mean, even higher than last year with the rate of inflation where it is and everything else. And so the number one way that people are losing money is they're continuing to sit on the sidelines with analysis paralysis and not buy their rental property. And the reality is that the best way to hedge against downside risk in real estate is to buy right and to make your money when you buy. Okay, so if you buy a cash flowing asset that is putting off, positive cash flow to you every single month, and you're going to hold it for the long term, then you're not really concerned with how much did the market appreciate this year, how much is it going to appreciate next year, what's all that kind of stuff, because that doesn't impact your rent. You just keep collecting that positive cash flow every month. And then, 10 years from now, or 15 years from now, or 20 years from now, then you'll see what the property is going to be worth. But what is it going to be worth next year or like 2 or 3 years from now? Doesn't really matter if you're a long-term real estate investor that's just going to continue to collect that cash flow and have your tenant paid on your mortgage if you choose to get a mortgage. All right, so what I want to do here is I want to make a special offer to everybody because we would love to get to know you in person, answer your questions, understand your buying criteria, and help you to meet your real estate investing goals. And that's different for everybody, right? And so if you would like to do a completely free video consultation with Maverick, I would like to offer that to all the NuView clients. You can just go to maverickinvestorgroup.com/NuView, and you'll be able to schedule a video consultation on our calendar for a time that is convenient for you. 100% free. We just want to get to know you and learn about your buying criteria and see how we can best support you in meeting your real estate investing goals this year. I also want to answer one final question. We're going to open it up for Q&A here. I'm going to flip it back to Nate in just 30 seconds here. So we can open the floor so you can start typing in your questions right now, and then I'll answer those. But I always like to kick it off with this question myself, which is, how does Maverick Investor Group make money, just so that you guys will understand our company's business model, okay? How and when we get paid. Maverick Investor Group is a real estate brokerage, okay? The beautiful thing about that for you is that in the United States, 100% of real estate brokerage fees are paid by the seller, 0 are paid by the buyer. That means you never pay any money to work with Maverick ever. All right. So we actually also set the business model up this way in person. So we will do a consultation with you. We'll work with you to try to help you identify properties that meet your needs, all that kind of stuff. And only if we can help you to find a property that meets your needs, that makes it through your evaluation criteria, that makes it through all your due diligence and everything such that you close on the property, only then do we get paid. And not by you, right? By the seller, all right? As a broker referral fee. So if we can't help you find a property that's a good fit for you, we make no money at all, right? It's just all free. But even when we do help you find a property and we do get paid, it's not by you. So you never have to pay any money to work with Maverick ever, which is my favorite part of this business model, because I just don't ever have to charge my clients any money, which is really amazing. And one of the things that attracted me to this business model, to be honest, so I don't have to actually sell anything, which is really, really awesome. I can just help my friends and my clients buy real estate and not have to charge them money. So I love that. And then of course, we also donate 10% of our net revenue to charitable causes and things like that. So that's how our business model works. And I want to encourage everybody to say hello, take a free video consultation, connect with us, and see if it's the right fit for us to help you identify rental properties. And with that, Nate, I'll flip it back to you.
Matt, thanks so much. I was taking notes, and a lot of the things you were saying are very, very true. One thing that, before we get to questions, we got to have a bunch of good questions come in here, so we're going to tackle all those in a second. But this is very, very important stuff, especially when we're talking about your retirement account. We have at NuView about 15,000 clients, $2 billion under management, but we have clients all over the country. We're based in, we operate out of Florida, so we have a lot of clients in Florida, but we have clients in California, we have clients in Washington, we have clients in New York, and they're always looking for investment opportunities. And sometimes the investment opportunities are outside of the state that you live in. Sometimes the investment opportunities, especially when you look at migration maps and, even stuff that's happened with the pandemic, you're looking for opportunities outside of your region or outside of your state. So knowing people like Maverick, and again, this isn't an endorsement to them because I can't endorse them, but he kind of brought up something, leaning on the expertise and the experience of other people that are out there finding property in other areas is going to be very important to you guys as investors, especially when it comes to your retirement account. And you always want to think about your retirement account because you have to invest that money. That's money that should be invested for your retirement. And you should have little to think about when it comes to those investments on a day-to-day basis. You should just watch the money roll in. I want to get to some questions here. And sorry, Grace, I lost where I find the, can you pop up the questions for me? We got a lot of good ones. I'll take the first one, which is actually talking about a client that's been talking with our Iras specialist, Tom. It looks like they set up their accounts very similar to how you set it up, Matt, with a Roth IRA and a Roth LLC. And basically, I'll sum it up. His question is, how do I transition my funds and my accounts from my brokerage account over at, I believe, Fidelity, and or Schwab, and how do I get that over to NuView? Easy. Just call us. I'm going to have our email address here. Call us, email us, talk to one of my IRA specialists, have them set you up with a NuView IRA or a NuView 401k, whatever it is that you qualify for, and have us begin the transfer of funds from your Charles Schwab account. Very important to know, when you're transferring assets or money from your brokerage account to NuView, we can't transfer existing stock. So we can't transfer your Walmart stock. If we're trying, you got to sell that, make sure it's cash. We can send the transfer request over to Schwab and they can transfer those funds over. And then once your account at NuView is open and funded, that's where you come into play. And then you're going to tell us what you want to invest in. So the process of establishing the account and getting the money over, it's pretty self-explanatory, but talk to one of my IRA specialists so we can get that ball rolling. I will tell you, the longest process in there is us waiting for the money to come over from a Charles Schwab or a Fidelity. No offense to those guys, but they like to kick back transfer requests. They don't like to see money move out of their control. So just make sure you get that process started, because I have seen people with investment opportunities that they want to take advantage of, and then they try to open the account and get it funded a week prior to their closing date. And it just can't happen because we can't get Fidelity or Charles Schwab to move in time. I think, again, not giving too many details, I think we dealt with this with Matt, right? We were trying to get your other custodian to get stuff moving, and sometimes they're just not very responsive when they know money's leaving their hands. So I just want to answer that question for you guys. We got some other good questions here. Anonymous attendee, thanks for joining us, anonymous attendee. This is for Matt. What typical property management charge are you looking to pay each month? I know kind of the answer, but tell them what you're looking for as far as property management goes. And then with that, I see another question, which you can probably tie in, is are you accounting the cost of financing in your cap rate. So how do you account for that?
Okay, so you can use, by the way, let me just be clear on this. You can use any property management company that you want, right? And when you're buying property, especially in a large city, large metropolitan area, there will be plenty of property managers. So what we will typically do is introduce you to a preferred property management company, which is preferred because they manage a number of these properties. And have a solid track record and everything else. And usually the fee is about 10% of the gross rent per month. So if you're getting, so like for my property, it's $1,000 a month gross rent. And I am paying $100 of that to my property management company every month to manage it and collect the rent and deal with the tenant and handle the maintenance and whatever else needs to happen. They're going to be doing that for me. And that's what I'm going to be paying. Now, some property management companies may have a different fee structure. It depends on the management company, and you're welcome to interview certainly more than one management company to see about that. And then in terms of calculating a cap rate, yes, a capitalization rate does not change whether or not you use financing, okay? So if you use a mortgage or you don't use a mortgage, that does not affect your cap rate. What that affects is your cash on cash return, okay? Because if you're putting a smaller amount of money out of pocket, because you're leveraging, now all of a sudden what changes is your cash on cash return number because you've put less money out of pocket, right? And you've increased your expenses with the mortgage payment, okay? So your cash on cash return changes, your cap rate does not change. Nate, you're muted. Okay.
Yeah, sorry. I brought this. I was actually looking at this morning, and I know that this is not the only source of data you look at, but I just thought that this was interesting, especially if you're, in another state, if you're a client that's looking for investment opportunity, looking at where people are moving, looking at where opportunities are. And, Matt nailed it on the head. When you look at Missouri, there's a positive a movement of people migrating to those states. And you can see, obviously up north, people are moving out of those states. And these are, this is obviously a report done by our people over at auction.com. Auction.com is owned 50% by Google. They spend a lot of money in research. They use this data to target areas of opportunity for themselves. And obviously this is a collaboration of the U.S. Census Bureau's information. So you can see, and our Florida clients, be happy, fastest growing, state in the country when it comes to opportunity. And I don't see any slowdown of this, especially with what things are going on. So again, I just wanted to bring this up because I was looking at this morning. A lot of the things you said, Matt, were making me think back to this chart. Just another piece of data. And I know you guys look at all sorts of things. One of the other things, and this is kind of a question somebody brought up, do you look at other things when you're looking at areas of opportunity, things that maybe be related to like crime rate or any other ancillary information that you may take into consideration besides the main things that people look at?
Yeah, so one of the really important things to understand as a real estate investor is that in any market, right, like St. Louis as an example, just because we've been talking about it, let's just use that, but this is true with any of the other markets. Most properties in St. Louis are not going to be a good real estate investment. Most are not going to be a good real estate investment. The reason is because most properties are either going to be too high end, too expensive, right? Too, in too expensive of an area that you're not going to be able to get enough rent to cover all your expenses and make that make sense as a cash flow property. Or on the other end of the spectrum, they're going to be too low end, meaning they're going to be in undesirable areas that are not going to attract quality, stable, long-term tenants and have a pride of ownership in that area and give you good resale value in the future on that property. That is most properties in any of these cities we're talking about. And so as a real estate investor, no matter what market you're buying in, you need to understand that reality and realize that you need to be buying your rental property in what we call the real estate investor sweet spots within each of these markets, okay? And those sweet spots take into account all of these things, right? I mean, that's why I mentioned you can go and pull a rent facts report, for example, for any property at the street level address and see all of those statistics about, school district and crime rate and all these other types of things. And you can also talk to the property manager to verify those things, right? So let's talk about, what we do at the very high level is we, first of all, work with local market experts. Okay. So the people on the ground that are sourcing these properties are local market experts that do this full-time professionally all day, every day. So they only buy in very specific areas, which are the real estate investor sweet spots. And then you get private access to those as off-market buying opportunities through Maverick. Now, part of your due diligence on any of those properties is absolutely to be, pulling a report like this, talking to the property manager, asking the property manager's opinion, calling another property management company, asking them their opinion on it, right? And that's all part of the verification and the due diligence process. But absolutely, starting off, making sure that you're buying in the real estate investor sweet spots is really important in any market.
Yeah, and I was going to say similar, this is why you lean on professionals. An area of opportunity does not mean the entire state or the entire city. There could be pockets within that city that are great areas for investing. So, lean on the experts, do your due diligence and try to deal with people that will take a lot of the headaches out of your investing. You don't want to be dealing with, vacancies and toilets and tenants and things like that. You want to have a property manager, some people in there so that you can live your life and cash checks that like Matt said. I think that's very important. I'm going to go to this next slide, and John Z, I want to have the slide and also attack your question, which is a question that we get very commonly. I'm going to relate it back to the actual process of buying real estate or alternative assets within a retirement account. And your question had to do with, can I use the depreciation on my IRA owned assets to offset my personal taxes? So I'll answer that question in the form of, let's just talk about the process here first. So when you're buying investments in a IRA, it's important that you have to work through a custodian. This is no different than you buying stock at Fidelity. When you set up an IRA with them, they're going to buy your stocks based on the purchase request that you make by pressing a button, and they're going to exchange your asset of cash for an asset of a stock. We exchange assets of cash for assets of real estate. The only thing that's different really is that the process of buying real estate is different than buying a stock. It doesn't eliminate the fact that we've got to deal with the title company, we've got agents, we've got insurance, we've got property taxes, we've got all sorts of things that come with real estate, but you still have to work through your custodian that's sending the money directly to the parties involved and signing the documents on your IRA's behalf. Because at the end of the day, your IRA is the owner of this investment. Even if you set up an entity like an LLC that your IRA owns and the LLC owns the property, the end owner of the LLC and ultimately the investment is your IRA. Your IRA is a separate entity. You have tax benefits in your IRA that you don't get as an individual. That's the beautiful part about using an IRA, is you don't have to worry about depreciation because there's no tax to depreciate against. So when it comes to your own personal taxation, that's a different story. You can't use the depreciation that your IRA is not getting anyways, but you can't use depreciation within your IRA, even if you were getting it, to offset your personal taxes. This is why it's important to own property outside of your IRA as well. Okay, if you need to offset your personal taxes, that's something that you need to look for as a personal investment. And you might want to own some real estate on a personal level through your own LLC, non-IRA funds. But if you want to grow a bucket of money faster, it's to take it out of the taxation equation altogether. And by owning property within an IRA where you don't have to worry about depreciation because there's no tax to the IRA. So how the process works, call NuView, set up an appointment with one of my IRA specialists, get them to establish an account. We start the transfer or rollover process so you can get those accounts funded. You locate the investment, whether it's through Maverick Investment or otherwise. We use your proper IRA vesting in most cases. If you're not using an entity to take title to the property, you submit some paperwork to us. We fund the investment and we own the investment in the name of your IRA, and you keep investing and keep investing, capital gains tax free. And essentially, once you get to retirement, if you've got the right accounts like Matt does, Roth IRA, Roth 401k, when he's 59 and a half, he'll be able to start taking distributions out of those accounts tax-free and penalty-free for the rest of his life, because the Roth IRA, he's already paid his taxes on that money. And once you have qualified distributions, any asset that kicks off income owned in your Roth IRA and you're above the age of 59 and a half, tax-free until the day you die. This is where the sweet spot in real estate with an IRA works, is because if you can accumulate enough income producing properties in an IRA and a Roth IRA, why would you ever do an investment in your name, the taxpayer, again? Just reinvest all the money that you have in your Roth IRA and live tax-free off of the distributions you kick off to yourself, completely tax-free. So just wanted to throw that out there. Matt, you want anything to add to that as far as a, forward thinking type thing?
Yeah, no, I think that makes a lot of sense. I think you nailed it.
Yeah. Let's see if we got any other questions. There's a couple questions that are specific to Matt. Again, Matt, I think you put your information in there. If you guys want to contact Matt directly and talk specific about his specific investments, just reach out to him. We do have a question that maybe me and Matt, you could take together. How does the LLC play a role in this equation? I'll let you take it first. Take the LLC role. Maybe talk to people about how you use an LLC personally versus in your IRA.
So the LLC allows you, the individual person, to have checkbook control by being the manager. Okay. So for example, if I was buying this property in my self-directed retirement account without an LLC, then the self-directed retirement account would have to sign for it, right? I'd have to send my documents over, and Nate would have to sign Nate's team would have to sign my, documents and all this kind of stuff. And that would take a whole process and all this sort of thing. And then if I wanted my solo 401k and my Roth IRA to co-own the property, then they would both have to be on the document, and they would both have to sign separately, and it would be a whole thing, right? And it would take quite a process. So instead, what I've done is I've set up an LLC, and I've just had my solo 401k and my Roth IRA put the funds and own 50% of it. And Nate's team at NuView has just moved they just move my self-directed retirement funds into the LLC. So that is the investing in the LLC. Now, whatever I want to do with those funds as the manager of that LLC, I can just do it instantly. So I can sign a real estate contract on behalf of the LLC instantly. I can take when my cash flow comes in, right? When my cash flow starts flowing in from my tenant paying the rent, I can invest that wherever I want. I can invest that in cryptocurrency. I can invest that in, anything that I want. And I don't have to call Nate and say, hey, Nate, I'm thinking about investing this money in cryptocurrency. Can you do this thing for me and make this move? All that kind of stuff. No, I can just do it immediately. So it gives you agility by having the checkbook control. Everything is much more simplified. And also it's a very convenient way of being able to use all of my funds in my different accounts together in one shot to buy assets, which I like.
Boom, nailed it. So you notice there when he's talking about his IRA investments and using the entity of the LLC, everything he said there, he was talking about ease of use. I want all my retirement funds, the funds that I can't touch right now, in one bucket that I can still make decisions for, but I don't want to have to go to NuView to pay for a can of paint or pay for this and pay for a new door. I want that to be able to just be all done through an LLC. He didn't say anything about asset protection, which is in most cases a moot point. It's more relevant outside of an IRA because when you're investing with your own personal money and you're buying a rental property, you don't want to be liable for slip and fall or something to come back on you. When your IRA or your retirement owns an asset like a rental property, you already have that isolation. It's not tied to you because it's not owned by you. It's owned by the retirement account. So you have that level of protection. The LLC just gives Matt and the clients that choose to set that up ease of use. I want to be able to send checks and reinvest the money without having to, go back to NuView every time and have to pay a fee for doing it. There's no right or wrong way to do it. It really just comes down to how active are you? What are you trying to do? If you're investing in things that have more moving parts, it might make sense to set up that entity, but there's some additional costs there as well. So again, this is why it's important to talk to an IRA specialist first. Tell them what you're investing in, and we can't give you structuring advice, but we can say, clients do it this way, or this way. Here's the pros and cons to this. Here's the pros and cons to this. Here's the pros and cons to this. Now you've got enough information to be dangerous with, and you can make your own decision. You want to say something, Matt? You look a little like you were going to add something.
No, I think you nailed it. That's great.
Okay. Last question, then I'll kind of, leave it to people contacting you, Matt, but this is a good one. Again, an IRA question. How do you handle RMDs? That's a great question, John. When we're talking about a retirement account at a certain age, if you have a certain type of account, you will have what's called required minimum distributions. Now, required minimum distributions only kick in for those pre-taxed accounts like a traditional IRA or a SEP IRA, so an account that you haven't paid taxes on. And when you hit that ripe age of 72, since you owe the IRS on the portion of those investments, they require you to start taking distributions so that you can pay taxes. Now, what's hard is if you have all of your investments in tangible assets, it's sometimes hard to liquidate a piece of real estate just to pay your RMD. So answer number one is, if you've got a traditional IRA, you own some rental property and you have to take RMDs, very important. You don't have to take the RMD from the self-directed custodian's account. You can satisfy all of your RMDs for all your custodians by just selling some of your stock at Fidelity. So you don't have to take an RMD from each custodian. You just have to satisfy all your RMDs by a distribution from somewhere. So sometimes selling off some stock is easier than selling off a house. But I will tell you this, the easiest way to get rid of RMDs, don't have a pre-tax account. Convert those traditional IRAs to Roth IRAs before you hit 72, and you won't be forced to liquidate assets just to pay Uncle Sam. Pay him, get it out of the way, and have those assets grow completely tax-free. And I've seen clients hold real estate in their IRAs, and as they're taking distributions, the distributions they choose to have, their assets go up in value because they own real estate that's appreciating, and they're getting in rents that are taking the place of either their RMDs or generating cash flow to their account. So you want to think about that ahead of time. Maybe get rid of the RMDs by just converting to a Roth, or just leaving some cash over at Fidelity just to satisfy those if that tickles your fancy. So Matt, I want to thank you. Is there any parting words for anybody on the program? We had a really good discussion, a lot of great questions. Any parting words for real estate investors or want to be real estate investors for this coming year?
Yeah, well, I just want to thank everybody for being here. There's a lot of very kind comments here in the chat. So I just want to thank everybody for all of your kind words and your positive feedback. And we would love to get to know each and every one of you. So a couple of people have asked for the link. Again, I have pasted it in the chat, and I pasted it in the answer section of the Q&A. So it's just maverickinvestorgroup.com/NuView. So we would love to schedule the consult with you, get to know you personally, and see how we can best support you in meeting your real estate investing goals for 2022. So thanks so much for having me, Nate.
Yeah, and if you guys are interested in setting up accounts, now's the time to do it. We're doing a March Madness type promotion where if you open your account for this month, we'll waive the account opening fee and give you a $50 credit to the account towards future fees. So what better time to get this stuff set up now? You can make contributions still for last year. If you haven't made your contributions to your IRAs, we still got a little time there before our tax filing deadline. So again, reach out to my team. You can find them at iraspecialists@nuviewtrust.com. Just email us. We're always ready to take questions, and we'll get those accounts set up for you guys and get the process started sooner rather than later. And if you want to stay up to date with all the things that NuView is doing, including our upcoming investor retreat, which is coming up in the summer, hint, hint, wink, wink. Stay tuned with us. Check out our YouTube channel. Follow us on Facebook. Follow us on all those channels so you can get the most recent updates as to what's going on in the self-directed IRA world. Again, thank you, Matt, and thank you for everyone that tuned in. We will see you guys next week for another Wednesday workshop with NuView Trust Company. Have a great week.
Thanks, Nate.